Hello everyone, how are you guys doing today? We are from Group 8 and we're going to be presenting about research in accounting for income taxes. But first, let me introduce to you guys our group. The first member is me, Putri Dianora, and then Alya Rohana Hamdi, Nadia Afriani, and Hafiza Putri Khalid.
In this presentation, we will talk about one article, and the title is Research in Accounting for Income Taxes. It's from the Journal of Accounting and Economics. The year published is 2011, and the authors are John R. Graham, Jana S. Reddy, Douglas A. Shackelford.
In this presentation, we are going to be talking about 7 agenda. The first is introduction. Second, why study accounting for income taxes. Third, overview of the rules governing accounting for income taxes. Fourth, earnings management. Fifth, the association between book tax differences and earnings characteristics. Sixth, the pricing of tax information reported in the financial statement. And seventh, closing remarks.
Hi, I'm Alya and I will talk about the introduction. This paper reviews one of the more complex areas of financial reporting, which is accounting for income taxes, or AFIT. AFIT is the process by which, first, future cash tax payments and refunds arising from current and past transactions are recorded as deferred tax assets and liabilities in an attempt to accurately portray the financial position of the firm. And second, the income tax expense is reported in an attempt to accurately portray the current financial performance of the firm. The authors find that these are the broad generalization of the study. First, managers use the tax accounts to manage earnings to meet or beat analyzed forecasts, but not for other objectives, such as to smooth earnings, increase a big bet, avoid losses, or meet prior earnings. Second, a small literature documents association between book tax differences and earning characteristics such as growth and persistence. Third, the evidence is inconsistent about the market's use of the information provided in the tax account. Fourth, by eliminating a second source of income information, conforming book and tax accounting would result in a loss of information to the market.
Hi, I'm Putri, and I'm going to be explaining why study accounting for income taxes. So, a large proportion of accounting for income taxes studies have focused on questions that have been very well researched in financial accounting, such as earnings management and the incremental content of financial disclosures. But do studies of the tax accounts produce new information? What is special about the tax accounts? So there are at least 4 features of accounting for income taxes distinguish it from other areas of financial reporting. First, income taxes are the only expense that all for-profit firms face, and taxes can be substantial, often consuming more than a third of pre-tax profits. Because tax returns are confidential, accounting for income taxes as the bridge between the financial statements and the tax return provides most investors with their sole source of information about current and future taxes. Second, besides providing information to the usual consumers of financial reporting information, the tax accounts provide information to an adversarial party, for example, the taxing authorities. In fact, the primary user of the tax information may be this adversary. The potential importance of the tax accounts for an adversarial party presents a quandary for managers. On the one hand, they face the usual incentives to account for income taxes in a manner that reduces financial reporting costs, which would normally occur by minimizing the income tax expense and thus maximizing after-tax book profits. Third, the tax accounts provide an alternative measure of income. Book income is based upon GAAP, rules promulgated by FASB and the SEC. However, taxable income is based on the tax code promulgated by Congress. The two systems have different goals and are influenced differently. Besides differences in the measurement of income, the statement of deferred tax accounts and the reconciliation of book and taxable income in the tax footnotes potentially provide users of the financial statements with information about the firm's profitability. And finally, the income tax expense is never included as a component of operating income. It is primarily reported as income tax expense or benefit immediately before the computation of net income.
Okay, here's Nadia speaking. For number 3, overview of the rules governing accounting for income tax. The background. The reason why they do the overview are because accounting for income tax only address to the reporting of tax information in the financial statement. No tax statute mandates or governs accounting for income tax. Whereas, in essence, the purpose of all financial accounting is to provide useful information to stakeholders, such as investor or creditors. And the second one, the rules and the principle that governs generally accepted accounting principle or GAAP are sometimes different from those that governs income tax reporting. Next is temporary differences. Temporary differences are differences in the tax and the book base of assets and liabilities. These differences in basis result in taxable or deductible amount in the future years when the asset is recovered or the liability is settled. To cover these differences, a company usually made this liability that called the deferred tax liability or DTL that reported on the company's GAAP balance sheet that measure the amount of the future tax liability that will be owed when the book depreciation becomes greater than the tax depreciation. For the asset, a company made this account that called the deferred tax asset account or DTA. A DTA used to measure the amount of future tax benefit that will be available when something like bad debts were expended under GAAP were deducted for tax proposed in a future year. Permanent differences. Permanent differences could cause different tax asset or liabilities or effective tax rate to differ from the statutory tax rate. For example, municipal bond interest is included in pre-tax income, but no tax expense is recorded. Then, earning municipal bond interest result in a lower effective tax rate or ETR. The tax footage of the financial statement provide information about the permanent differences through a reconciliation of the effective tax rate to the federal statutory tax rate. When firms take uncertain tax position in their tax return, there is some chance that they will be required to pay tax related to this position in the future. So, to accrue these expenses, the firm established liabilities on the balance sheet that known as tax contingencies, which estimate the taxes that might have to be paid in the future. But although the uncertain tax contingency account included among the other liabilities on the balance sheet, it has rarely been reported. It has a separate line item or even disclosed. However, since 2007, a new financial reporting standard has required firms to disclose the balance of the tax contingency in their financial statement footnotes. This Next, permanently reinvested foreign earnings. So accounting principle board number 23 permits manager to choose between permanent or temporary treatment if the US tax rate exceeds the local tax rate for the foreign subsidiary. So GAAP permits corporations to record the residual US taxes in two ways. The first one to create a temporary differences, leaving the ETR unaffected. Specifically, a firm estimates the US tax that will be required at repatriation and accrues the income tax expense when it records the foreign earning that will eventually trigger those US taxes. The second option is defer the expense until it decided to repatriate the funds if the firm does not expect to repatriate the profit in the future. So when a company makes this choice, the foreign profit are termed permanently reinvested earning or PRE. This therefore reduces the ETR because if the firm never repatriates, then it never pays the US taxes.
Okay, I will explain number 4 about earnings management. Divided into 5 sections, there are 4.1 Studies of earnings management via the valuation allowance. Managers believe that some or all of the future tax benefits of a deferred tax asset will never be realized. They establish a valuation allowance or VA account as an offset against the deferred tax asset account. The VA earnings management studies provide somewhat mixed evidence as to whether managers use the VA accounts to manipulate earnings. There is no evidence consistent with smoothing behavior. However, recall that there is room for sample compositions and other empirical improvement in this area. While there is mixed evidence that firms use the VA to increase their losses in a big bet, the most comprehensive Frank and Rego 2006 conclude that the VA is not used in this manner. Similarly, there is limited evidence that managers use the VA to avoid losses and meet prior earnings. Meeting or beating analyst forecast is the only objective for which there is consistent evidence that non-financial managers use the VA to manage earnings. Next is 4.2 Studies of earnings management via the tax contingency account. The contingency balance is an estimate of how much the company will ultimately remit to the government related to the aggressive tax position. Since this estimate is subjective, it could allow for considerable manipulation. Testing for earnings management through the contingency account is not the primary purpose of Blue ETL 2010, and thus it is unfair to criticize their paper for its shortcomings in shedding light on earnings management. However, in the spirit of learning from their work, note that Blue ETL 2010 suffers from at least two weaknesses. First, the earnings management tests are somewhat weak. Second, the sample size is only 100 firms, limiting the study's generalizability. Third, their study is primarily about possible opportunistic behavior at adoption of the standard, rather than the more interesting and important issue of ongoing earnings management behavior. The use of the tax contingency to manage earnings on an ongoing basis, and in particular, whether this behavior occurs since the effective date of FIN 48. Next is 4.3 Studies of earnings management via discretion in reporting the U.S. tax expense on foreign profits. Another accounting for income tax opportunity to manage earnings involves the reporting of U.S. taxes on foreign profits. However, presently very little research addresses whether and why managers exploit the discretion under APB 23 to manage earnings. Presently, only a very limited amount of research addresses whether and why managers exploit the discretion under 23 to manage earnings. The inference drawn from Kroll 2004 is similar to those inferences drawn from the other accounting for income tax earnings management studies. That is, firms are more likely to defer recognition of the residual taxes if the deferral better enables them to meet analyst forecasts. Then 4.4 Other studies. The papers discuss above study specific tax account in search of evidence of earnings management. Another approach is to investigate settings where earnings management is suspected and then look for patterns in the tax expense consistent with earnings management, without specifying the balance sheet account that is being manipulated. Although knowing the specific balance sheet account through which manipulation is occurring is important, the evidence about whether firms manage earnings through the tax account is sufficiently scant that we find merit in any documentation of accounting for income tax earnings management. Next, 4.5 Future research in earnings management. A consistent pattern emerges from the extant research on earnings management. Firms use the tax accounts to manage earnings to meet analyst forecasts, but not to manage towards other goals. Although this field has reached some maturity, a number of issues remain unresolved. The remaining of this section highlights 8 unresolved research questions. First, it is somewhat unclear why managers would not use the tax accounts to meet or beat prior earnings. Second, while Gupta et al. 2010 conclude that managers are not using the tax contingency to meet or beat analyst earnings forecasts, Kaiser et al. 2010 conclude the opposite. Some resolution of this issue is required. Third, we have very little information related to whether and how the users of the financial statement see through the earnings management of the tax accounts. Fourth, given the discretion permitted under APB number 23 as well as the limited required disclosures in this, surprisingly few papers analyze this option to defer recognition of the residual U.S. tax on foreign earnings. Fifth, besides earning management, the option under APB number 26 and 23 to reduce the ETR provide researchers with an opportunity to study the importance that managers place on the ETR. 6. One of the distinctive features of accounting for income taxes is that the tax expenses occurs below the computation of operating income on the income statement. 7th, the extant literature largely ignores the IRS audit implication of managing the tax accounts in light of the adversarial role of the IRS. The tax accounts provide a setting for an interesting question that cannot be easily studied using other accounts. Finally, if the U.S. ultimately adopts the IFRS rules related to accounting for income taxes, the decision to elect permanent reinvestment could be interesting to study.
Okay, the next is the fifth part is the association between book tax difference and earnings characteristic. A few studies explore that the association between book tax differences and various earning characteristics. Leff and Nissim 2004 focus on how the magnitude of the book tax differences affects earning growth. They posit that the ratio of estimated taxable income to book income (TIBI) is a measure of earning quality for 3 reasons. First, discretionary accruals are included in book income but often are excluded from taxable income. Second, if firms time transactions to smooth taxable income, then estimated current period taxable income should reflect management's assessment of future taxable income. Third, since firms usually recognize income or deduction for the tax purpose before or after they recognize revenue or expenses for book purposes, a high ratio of TIBI should predict high or low future book revenues or expenses. There are problems in their study. First, the authors assume that the only form of tax planning involves smoothing taxable income across years, which is obviously only one type of tax avoidance. Second, there are many potential determinants of the book tax difference. Another interesting paper that also contributes to the search of AFIT studies is Hanlon's. She study she studies of the potential information contents of BTDs. She focused on deferred tax timing differences and tests whether BTDs affect the persistence of earnings, cash flow, and accruals. There are a few issues to consider when interpreting the result of this study. First, any one-time accrual could cause the association documented with persistent there are of and yet have nothing to do with earnings quality per se. Second, estimated taxable income for large firms does not exhibit incremental explanatory power over book income. Third, in addition to earnings, cash flows exhibit less persistence when the firm has extreme book tax differences, raise concerns that the change in earnings quality arise for reasons other than BTDs. And there are also other studies suggest that BTDs are associated with earnings characteristics, but room remains for future research in this area. As we know, every firm is subject to taxation. Taxable income provides information about an alternative measure of income. It's reasonable to think that there would be information embedded uh, in the accounting for income taxes that would be associated with earning characteristics. The AFIT literature needs a more expansive view of earnings quality because until now only earnings persistence and earnings growth have been used as measure of earning quality. Additional measures of earning quality include accruals quality, smoothness of earnings, nearness to earnings targets, timeliness, and conservatism. Finally, the association between earnings quality and temporary timing differences needs further examination.
Hi, it's Putri again, and this time I'm going to be explaining about the pricing of tax information reported in the financial statements. So, the evidence reviewed in this section is mixed as to whether and how the market uses the tax accounts to set prices. Several important results are found. First, the market appears to price the deferred tax accounts and does so in a manner that reflects the length of time until expected reversal. However, this influence is largely drawn from studies that use price levels regressions. Ignoring those studies, the evidence is mixed about whether the market prices the deferred tax accounts. Second, market prices are positively associated with size of the tax contingency. Third, taxable income, estimated using tax information in the financial statements, provides information to the market incremental to the information in book income. However, the relative contribution of estimated taxable income decreases to the extent that firms engage in aggressive tax planning. Fourth, firms with large book tax differences, low values of the tax income or book income ratio have lower PE ratios, presumably due to the association between the TIBI ratio and future earnings growth. However, sample limitations make it unclear whether this result is generalizable. Fifth, unexpected taxable income estimated by grossing up financial statement tax expense and the ratio of taxable income to book income predict future returns, a finding that attributes to the failure of analysts to properly use the information in estimated taxable income.
Number 7. Closing remarks. This paper reviews and evaluates research about tax information in financial statements. Historically largely overlooked by both financial accounting and tax researchers, no area of tax research and accounting is presently attracting more scholarly attention than is accounting for income taxes. In conclusion, accounting for income tax research has blossomed in the last few years, vastly expanding our knowledge about the use of the tax information in the financial statement. Assuming a framework develops to better interpret extant empirical findings and guide future study, there are many questions that still need resolution. We look forward to research that leads to a deeper understanding of the tax account in the financial statement.
And that would be all for our explanation about research in accounting for income taxes. Thank you guys so much for listening, and if you have any questions, please just let us know. Again, thank you so much for listening. Have a good day.